Right. A face melter rally could be on the horizon. What we've seen over the last 6 months, pretty good, not bad for the crypto markets. We're going to take a look at where the next 6 months may take us and dive in a little deep. I think you guys are going to like this one. My name is Paul Barron. Welcome back into Tech Path. Joining me today, of course, is Mr. Mark Yusko, coming in from Morgan Creek Capital. Great to have you.
Great to be back, and good to see you again.
Yeah. So, Mark, I want to open up with a clip of you talking about where the market is. Listen in.
There will be a face melter of a rally. And I said, we saw a hint on Monday and Tuesday. We have companies that are down 90, 95, 98%. When I'm talking about the face melter, I'm really talking about equities. In crypto, right? I think crypto winter ended on June 13th. I think we're in crypto spring, which will last through first quarter next year. Yeah. I'm not worried about crypto at all.
So, I mean, you hit it right on the head there, Mark. Good for you. We saw the 16.5 low, and now we're setting above 30K. So not a bad return if you're in the crypto business over the last 6 months. When you look at that clip, this was one that was about 6 months ago for us here on this channel, and you look at the forward-leaning ideas of what we're seeing both from the SEC, what we're seeing in the potential opportunities around ETFs. What's your next step here? Where do you think the market's going to take us?
Look, I mean, I hate to say it because I don't want to overpromise and underdeliver, but I think we're really just getting started.
Yeah.
Look, the cyclicality of digital assets is real. It's this 4-year cycle, and why do we have a 4-year cycle? Fear and greed. And it's kind of baked into or coded actually into the way Bitcoin in particular works, right? You have these block rewards, the amount of money or the amount of Bitcoin that is rewarded to miners for securing the network. Every 4 years, that number gets cut in half. Now, whoever thought of this, whoever he, she, they, Satoshi happens to be, it's absolutely mad genius. Well, why is it mad genius? Well, it creates movement. Well, why does it do that? Well, if you think about it, the miners, their core costs are basically fixed, electricity and the machines. And so if suddenly your revenues were cut in half because the block rewards get cut in half, most of them will go out of business. So what has to happen? The price has to rise. So there's a built-in movement of the price. And once the price starts to rise, people start to follow, right? That's what traders do. They look for movement. Yep. And then that creates more movement. And so we get this exacerbation of the trend. Now, part of the problem is it starts undervalued because the beginning of the cycle post the halving usually occurs around, a period after the crash, the previous crash.
Right.
So we have crypto winter, prices fall, prices are undervalued, anticipation of the next halving comes along, and investors start accumulating assets. Well, what's an investor? An investor is someone who buys an asset that sells below its fair value. So today, fair value, depending on the model that you look at, the model I like, which is based on Metcalfe's law, says that fair value of Bitcoin is around 55K. Okay, so at 30K, we're below that. So as an investor, I like to buy assets that are below fair value. Well, then what will happen is as you get out of crypto winter into crypto spring, which a year ago we went into crypto spring, as we talked about, it's choppy, it's volatile. You kind of don't end up much different. I think over the past year, we're up about 50%. Now, that's a good move, but it's not the 100% off the cyclical low, but it's a nice move. Well, now, as of this June 15th, a month ago, now we're in crypto summer. Well, what's crypto summer? Crypto summer is the year leading up to the halving, usually has an upward bias toward that fair value. So my guess is that between now and the halving in April, we'll drift slowly and calmly up toward that fair value. And then what happens is after the investors get their fill, buying the asset below fair value, then the speculators come in. Well, what's a speculator? speculator is just the opposite of a hedger. Well, what's a hedger? A hedger is someone that has to sell something because they're producing it, like the miners, right? They're selling their Bitcoin as they produce it to pay for electricity and machines. Well, a speculator just takes the opposite side of that. They're not good, bad, or indifferent. They're just,
Right.
There's a seller, there has to be a buyer. For every seller, there's a buyer. For every buyer, there's a seller. So that pushes us up above kind of fair value. Well, then what happens is we get the parabolic, crypto fall, kind of the Indian summer, the big move. And that's where the punters come in, right?
Yeah.
The really levered.
Yeah.
And they're going to push the price way above fair value. And then we'll have another crash, another crypto winter. But so I would say that's a long-winded way of saying kind of between now and the halving in April, my guess is we drift upwards towards 50K. From
when you look
April to the following April, that's where I think we could double or even treble into the fair value. By then will drift upwards toward that 100K, which is what I think is fair value for this halving.
Timing is really interesting here, because if you look at, this is just Blockworks coming in on multiple spot Bitcoin ETFs, or only, will it only be BlackRock will be the question mark. So are they essentially going to become kind of the kingmaker for the ETF side of things? And back to your point, there is a cycle here. We also have an election coming in that plays into this. And along with that, this was just a quick tweet by Cameron Winklevoss. Also getting into it was former chair Jay Clayton, who's outlining the arguments for why spot Bitcoin ETFs should be approved. So it seems to me like there's a lot more snowball effect starting to roll out of DC and traditional Wall Street. Timing is eerily close to exactly what you're talking about in these seasons of crypto. With that being the case, and this is something that I've had many debates on, is if we do see and this is a big if we do see a Bitcoin ETF that does come through, the opportunity, do you feel like this will be the cycle in which we will see the largest move, or do you feel like this is still going to be one of those early adopter cycles in the in the annals of Bitcoin?
The early adopter move is over, right? I mean, we're past the kind of 11% early adoption. You think about the S curve. You get the first 10, 11% over the first decade. You get the next 80% over the next decade, and then the maturity, after that. And so I think we're past early adoption. Now, part of the challenge is the law of large numbers, right? When we went from the first halving from 10 to 100, 10x move, okay? That was pretty easy because you're talking really tiny numbers, didn't need a lot of volume to get to $100 a coin. I mean, and then you went to 100 to 1,000, another 10x move. And that's a little harder, but still pretty easy. You go to 1,000 to 10,000, that was the last halving. That was tougher, although we went right through 10,000, right up to 20,000 before the crash. Well, this halving, I think, is 100,000 at fair value. So it's a 10x between halvings. Why 10x? There's lots of different reasons for why that works on the Metcalfe's law parabola. But let's just say we get to that 100,000 for fair value. Mm-hmm. It's a lot harder to go from 10,000 to 100,000 than it is from 1,000 to 10,000, right? Just need more people, more dollars. Yep. The market cap gets bigger. We're talking trillions, plural, as opposed to $500 billion. So I think it will be tougher to get the same kind of percentage move, but the total dollar move will be much bigger.
Yeah.
And that's where this supply demand comes in.
Exactly.
Not if, but when, and I believe when BlackRock is awarded their crown and they become the king and they get the first Bitcoin ETF, even though they don't, I won't say deserve it in the sense that they were not doing the early adoption work. They were not, the ones there believing in it, but now they are part of the inner circle and they know who to influence. I won't say anything negative, but they know who to influence to get the job done.
Yeah.
And so I think they'll get the first one. Now, whether anyone else gets it, I don't know. I look at the gold ETF, right? The gold ETF delayed 4 years. 4 years we waited for the gold ETF. And then they gave it to one group. GLD took off. Now there are other gold ETFs that came along, but they're much smaller. GLD really is the axe.
Yeah, well, it's the first mover.
It probably plays out this way.
Yeah, the first mover always has these kinds of advantages, especially in a market that's moving so quickly like crypto. With that being the case, when you look at that and the potential here for what the market might do in the next year to 18 months, do you feel like this is the last cycle for major moves in Bitcoin, Ethereum, or do you think there will be another cycle after this before we see really kind of the absolute barn burner crashing the door down?
Sadly, cycles repeat. So we will have another bear market, right? After we run, because again, I say, it's just me, I say fair value for this halving sometime in 2024 is 100K. Okay, that's my view. Okay. I think we'll go far beyond that because greed and speculative fervor and leverage. Now, I don't think there'll be as much leverage this cycle, Paul, as there were in the last ones.
Right.
So could we get to 200K? Could we get to 250K? Tim Draper and I have talked about that 250 number is kind of half the value of gold. Yeah, I could see that. Yeah. But then we'll have another
there's
crash.
Still a lot of room.
Yeah,
for sure.
But then think about it. The next halving, which is in 2028, I will argue that's another tenfold increase as we get broader adoption and we go up the Metcalfe's law curve. That takes us to $1 million a coin. But
so you're in the same camp as me. I believe that this run will be a big one, albeit, if it's influenced by an ETF or, other institutional players starting to get into it. I don't know that we'll see as big of a pie jump in as opposed
if we
to
go
the 2028 number.
Let's say we go from 30K where we are today. Let's say we go to 150K. That's a 5X.
That's a 5X. Yep.
That's nice. That's nice. But then if we go from 150K to $1 million, that's 6-7X. That's not that different. And actually, the 5X we're talking about is really 10 because we started from 15, not from 30.
Yeah, exactly.
So it's really a 10X.
Well, it depends on where the market falls to. Yeah, it depends on where the market falls to.
You go back to the 13 bull market, we had like a 40X move. Then the 17 bull market, we had a 20X move. This time we probably have a 10X move. And the next one, we probably have a 5X move. So the order of magnitude in terms of total dollars is much bigger.
Sure.
But the multiple is smaller just because of the law of large numbers.
All right, so a couple of things have been happening here that the SEC continues to kind of, flex their reach. One, this was a tweet kind of talking about Ethereum and DeFi projects getting, potential, exposure to where the SEC is trying to do some things with DAOs. This was an article, SEC wrongfully attempting to police crypto markets. This was the Paradigm Council. My look at this, especially if you think about projects like Solana, Ethereum, and other L1s that are doing, Avalanche could be thrown in there, Cardano could be even thrown in there. And there's a lot of pressure on these. Some of these are now being listed as securities, some are not. What is the likelihood of us seeing these blast-offs in this particular bull run that we're talking about right now with some of these projects that are already facing these challenges? Because many of these did not face that challenge in the last bull run. What are your thoughts there?
Yeah, no, look, I think it's a fantastic question. I think, look, Jay Clayton, I thought did a great job when he was, head of the SEC. Why do I say that? He was measured, consistent, and prudent. All the things that you could ask for if you're on the other side as an innovator trying to disrupt these gigantic markets. And I admire that, right? It's really hard to be objective. It's really hard to be measured. It's really because you don't get a lot of press from being measured. You get a lot of press from being hyperbolic and flamboyant. Our current guy, and again, I'm not going to criticize, particularly not going to criticize the guy that regulates me, but I would say on the measures of consistency and objectivity and consistency, doesn't get the same high marks, right?
Yeah.
I mean, if you're just, I think even if he were to grade himself, he wouldn't give himself the same high marks. But there's lots of clips of him saying one thing and then saying the exact opposite later.
Sure.
And like that's hard. It's hard to work when you don't know the rules. It's like raising a child. Mm-hmm. If you don't give your kids rules, they founder. They don't know what to do because, wait, I'm supposed to have a rule. I'm supposed to have a curfew. I'm supposed to have things that I can and can't do until I'm a certain age. And so I think that's a long-winded way of saying in DeFi, Clayton was very clear. These things are not securities. But if you did something that resembles a security offering, like an ICO, sure, yeah, we might have a problem. But they didn't selectively enforce the way the current administration is. And that makes life really hard.
Yeah.
Because now what you're saying, it reminds me of this joke, Paul. There's this joke about the IRS, right? IRS says, hey, Paul, you owe me money. You're like, oh, okay. How much? IRS says, guess. Okay. 25,000. Wrong. Jail. But you said guess. I mean, if you know how much I owe you, just tell me and I'll happily pay it. Maybe not happily, but I'll pay it. And I think the same thing's true here. If you know what the rules are, set them.
Yeah.
But don't play the game, or worse, let me play the game, or let Coinbase play the game, or let Kraken play the game, or let Binance play the game, and then say, yeah, I didn't like that, so I'm going to change the rules. So now you violated securities law, but you said this wasn't a security. Well, I changed my mind. Jeez. I mean, It's like getting 10 yards in a football game and saying, no, you know what? 20. It's 20 now.
Right.
It's not 10 anymore.
So Mark, when you look at that and where we have come, I would say in a fairly short period of time with what the SEC has done, in terms of rulemaking, especially around some of these alternative coins, tokens, et cetera, what we'll see in this next bull run, do you feel like there's any relief coming? I mean, when you look at policymakers, what they're currently doing in DC, where the SEC, we already know there's a cycle ahead of us. I think Gensler's got about 1,000 days left right now before he would be potentially ousted by the next administration. Yep. So, I mean, there is a somewhat of a link. We've
seen it. No, we've definitely seen it. So we got some clarity with this new exchange, right? Mm-hmm. That's backed by Citadel and a bunch of the incumbents. They're basically saying Bitcoin, Ethereum, Litecoin, and Bitcoin Cash, we're going to do those. Mm-hmm. Because it's pretty clear that those are not going to be labeled securities. Now, you can't get the chairman of the SEC to say that about Ethereum. He's still hedging on that, even though it seems pretty clear to me it's not a security. But okay. But if Citadel and Fidelity and Schwab are going to get their name and brand and reputation involved, it's probably pretty clear those four are okay. Beyond that, I could make a case that Avalanche and Solana are pretty good. I can make that case. There are others that might make the other case, but I just think the hard part of working in an environment where you don't know the ultimate rules is you can make a mistake, not out of malintent, but just by accident. And that's a tough way to live.
I agree 100%. We've talked about this ad nauseum, I think, but I feel like there is a bit of a light at the end of the tunnel now starting to appear. whether we see some regulation start to form under stablecoins, which I think will be the first move,
Yep.
coming in DC, and then possibly an ETF. All that good. Those are good at least indicators, and I think also the market's kind of shown that. This was a report that was done here recently on crypto custody, and this is kind of an interesting aspect, and it's talking about how people are holding crypto, what they look at in terms of speculation. One of the things that was identified in the report was that people weren't looking as much at tokenomics as most of the crypto hardcore truly do. And
Yep.
I'm just kind of curious, do you feel that that is an important measure still in the investment side? Obviously, within securities, everybody has fundamentals, everybody has a profit and loss. You get all the data you need to be able to make a solid investment. In crypto,
Yeah.
it's a little bit different. What are your thoughts there?
Look, it's one of my pet peeves in this whole thing. Look, if we're going to change the definition of security to anything that you acquire with the expectation that the price rises,
Sure.
everything is a security. Piece of real estate is security. My Pokemon cards that I do with my son are a security.
Security.
You know, it gets to, and so I think, unless it was misreported, but I think the chairman might have even said if Beanie Babies came out today, yes, they would be deemed as security.
Mm-hmm.
That's just silly. I mean, that's like saying something that you don't believe to make a point. I mean, that's crazy. So I think if we're going to go to changing the rules, and look, I have a fundamental problem. The regulations were written in 1933 and 1940. That's a long time ago. A lot has changed since then. And the idea that those rules that arguably were written to prevent the fraud that was going on in the roaring 20s, you know, boiler rooms and stock promotion scams and all that kind of stuff, just didn't anticipate things like virtual currencies and different forms of custody. And I do think changing the focus to things like custody as opposed to issuance or expectation of profit is a step in the right direction. But even then, now we're going to get a capricious decision that, well, if I can physically touch it like a bar of gold, then it's a commodity. But if I can't physically touch it because it's digital, then it's not a commodity.
Right.
Well, no, that's crazy, right? If I think about what Bitcoin is, it essentially is digital gold. It's a scarce asset that is held with the anticipation that it will preserve value relative to the destruction of the underlying currency.
Yep.
Right? A bar of gold, an ounce of gold, equals an ounce of gold. Forever and always.
Sure.
You weigh it, it stays the same. It doesn't change, doesn't grow, doesn't change, doesn't dissipate, stays an ounce of gold. But wait, an ounce of gold is different. For 5,000 years, a single ounce buys a fine person's suit, right? From the days when the Knights Templar were running around Spain and Portugal, where I just was on vacation, okay, 2,000 years ago, to today, a fine person's suit, 1 ounce of gold.
Yeah.
Money has gone up and down and up and down. Same thing with Bitcoin, right? One Bitcoin is one Bitcoin, but we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars and euros and yen and lira. I always say all the time, there's never been a bear market in Bitcoin in Turkey because the Turkish lira has gone straight down. There's never been a bear market in Venezuelan bolivars, not once, right? The value of Bitcoin in bolivars just keeps going up because we're devaluing the currency. So the role of Bitcoin is precisely the role of gold. It's a store of value that preserves purchasing power relative to the destruction. And here's the crazy thing. Larry Fink said this the other day.
Yeah, just the other day.
He said that Bitcoin can protect you from devaluation of the currency, of the dollar.
Yeah.
Wow.
That's insane to hear BlackRock making that kind of statement. Yeah.
That's a wow.
Pretty crazy.
If I say it or you say it, that's fine because we're crazy conspiracy theory guys. But for him, sitting in the chair of the king,
Yeah.
that's a big deal.
Well, it gets back into the point where I think a lot of people have been speculating, that is that finally, the institutional and also Wall Street to a certain extent has got a chance at this now of being able to participate in a very large way and start to change the game and set the rules as they go, which is why I think the US is still lagging behind most of the world, whether you look at Hong Kong or the UK with MICA and all those scenarios playing out on this. A couple of things I want to hit on here is Vanguard goes in, drops some money in Riot. So that's still showing a lot of support into the miner sector. That's going to be big. If you're, and this is just a quick question for you, if you're betting on this next run, would you be looking at the infrastructure plays? Would you go after the core blue chips? I'm sure you're going to give me a balanced portfolio here. Or would you look at Web3 and some of the gaming opportunities, whether you look at Solana, AVAX, some of the things that are happening over there for the best bang for buck?
You answered the question, right? The answer is yes. So, we run a venture fund and we invest in the ABCDs of the digital age.
Yep.
AI, blockchain, chips, and data.
Yep.
And so anything that touches those four pillars, so think of four Roman pillars holding up a temple, anything that touches those four pillars, we want to own. And miners, definitely. Exchanges, definitely. Software and tools, definitely. AI is really just a form of software. It's just a tool. Blockchain technology is a better form of storing value. Chips, right? We're going to have ASICs and AI-focused chips. Those are going to be great investments. And then data, ultimately, it's all about data, right? The future of digital assets is about how we store and process data, how we protect privacy. You think about what we're talking about here is the internet basically revolutionized commerce and media, right? In the old days, media was controlled by governments, state-owned and state-controlled, and the internet busted that wide open. So anyone could be a journalist. If I want information, I don't have to wait for the New York Times. I can watch a TikTok or watch a Periscope on Twitter, find out what's going on in Argentina much faster. What blockchain does, it takes us away. I'll give you a quick history lesson. I knew this, but I didn't know exactly, until I just got back from this vacation. So I always said that the Medicis invented the modern banking system, fractional reserve banking, but they stole the idea from these monks. And I actually didn't know which monks until last week. I was in Portugal, and the guy explained to me that the Knights Templar, the Order of Christ, invented fractional reserve banking. The Medicis borrowed that idea and created the modern banking area that we have today. But it goes all the way back to these Portuguese monks. And what they found is they would hold gold for people. People would go off to war and never come back. I'm like, well, we got all this gold. We might as well lend it out and earn some interest on it. And it snowballed into, modern fractional reserve banking. Pretty amazing. And so that was all based on ledgers. In the olden days, I lent you money. I wrote in my ledger and you come back to pay me. I'm like, oh, Paul, you think you owe me 100. It says 200 right here because I'm an unscrupulous guy. I changed the ledger. So you're like, well, that sucks. So I'm going to keep a ledger. And you keep a ledger, and we'll ask the Medicis, the benevolent Medicis, to make sure the ledgers match.
Yeah, they were the gatekeepers.
Unscrupulous guy. I go to the Medicis. I say, hey, guys, I'm going to change my number to 200. Paul's is going to say 100. I'll give you 50. They're like, done. Easy. So that you come back to pay, and mine says 200, and you're like, hey, Medicis, it should be 100. I'm sorry, Paul, you must have made a mistake. Well, now we have a third ledger. We don't need the Medicis. We don't need JP Morgan. We don't need the global banking system. We have a third ledger, immutable, permanent, and we're going to replace trust, which is what this 800-year system is built on, with truth. blockchains give us truth. And that's why, one, I'm so excited about this. Two, it's why I'm going to spend the rest of my career focused on this. And it's three, why we're just at the beginning of this adoption and this disruption. And yes, the incumbents want to preserve what they have. $7 trillion. $7 trillion. This is a big number. $7 trillion every year leaks out of your account and my account and everyone else's account into the banks, brokerage, insurance companies, title, all the things that ensure trust. Mm-hmm. How about if we keep that $7 trillion?
Whew.
In fact,
we just did a video on this. We're going to release it later today on the banking system, and exactly to your point right there.
There you go.
Exactly. Just the amount of, and why there's been such a fight for this. This is not over yet, but I think it's going to be a scenario where it plays back to the things you've talked about before, and that is that traditional finance is going to find their way in here. And at some point,
of course.
Yeah. And at some
Ken
point,
Griffin is going to get his part.
Yeah,
Ken,
along with many
one
of
of
the
the smartest
others.
guys I've ever met. He will find his way. Larry Fink will find a way. Jamie Dimon will find a way. And that's okay, because ultimately, as long as the slippage goes down and the individuals own more, right? Web 1, read only. Web 2, read write. And who got rich? The owner of these centralized apps.
Yep.
Read, write, own. Web 3, we all stay, we own our content.
Yeah,
we own our assets. We own our data. We own our information. I can choose to vend it. I can choose to trade it, but it's under my control. And that's the part that these middle people don't really like.
Right.
But there'll be a transition. It's like TradFi, CFI, centralized finance, decentralized finance. Ultimately, we get to DeFi, but it's going to take time.
Yeah, definitely. You're talking about this transition of adoption and some of the things that will happen around some of the major industries out there. I want to look at one here, and we're going to jump to, I want to show two projects. One is Parcel, which is a Solana-based project that is basically working on, speculation on how real estate markets work. Mm-hmm. Along with that is a program called Homebase, which is where you can actually invest fractional reserve, fractional shares in properties. So this is starting to slide into the real estate market. And then I want to play a clip for you real quick here. Let me get this clip here, and then let me flip this to you. Listen in.
But I think the rally is just beginning over the next year.
I'm just not convinced that this matters. It seems to me that crypto and Web3 kind of lost the narrative. Now that narrative has moved to AI, and crypto is sort of more in the metaverse bin.
Kind of silly to say it's in the waste.
We're not talking about NFTs or virtual real estate in the same way anymore. People aren't trying to buy the virtual place next to Snoop Dogg's house. Like, people are concerned about actual commercial real estate right now.
All right, so obviously somebody that doesn't understand really where this is going. What we've already started to see is real movement in some of the bigger sectors, and this is just the beginning. We'll continue to see that kind of angle, especially in projects like Solana, Avalanche in the gaming sector. Ethereum will start to fractionalize everything, tokenize the world. And even Fink kind of mentioned this the other day on Fox Business when he was breaking this down. He was talking about Ethereum, in the sense of what we were going to see in terms of tokenized securities and so many other things that play into that. If you were looking at one sector right now that may benefit the most from this over the next, say, 5 years, would you look at securities mostly, and banking, or do you feel like real estate or some other sectors might show up?
No, I think that's a great question. I would say tokenization of assets of value broadly. So stocks, bonds, currencies, commodities, real estate, private businesses, anything that can be owned, anything that can be titled. I actually believe, and there are people who will disagree with me, but I believe that anything that can be titled will eventually be an entry on a blockchain, just an entry in this permanent immutable ledger. And that's what a token is, right? A token is not a little piece of gold or a little, I mean, that's not what token is. And media makes it look like that. But a token is simply an entry on a ledger that gives you or I title to some property. And that property could be anything. Now, at this point, it's been things like Bitcoin or Ethereum or the token, the line items themselves. We own a piece of the computing network that is the Bitcoin blockchain, or the computing network that is the Ethereum blockchain. What people don't realize, I always hear all the time, it's Bitcoin, not blockchain. Bitcoin is a blockchain.
Yeah.
And what you own is a piece of the most powerful computing network the world has ever seen. It's 1,500 times more powerful than the CERN supercomputer. And it is so powerful because of proof of work. And it's so immutable. And so, and I believe all high value assets will eventually list and find themselves on the Bitcoin blockchain. That's why ordinals are so important and a bunch of other things. But ultimately, Ethereum can have a role, Solana can have a role, other things can have a role too. What I don't know, Paul, and I've thought a lot about this, and I don't know that I have to know, is the internet's pretty simple. It didn't used to be. There used to be 80 different protocols, and it was very messy, and now we have 5, basically. Right? We got internet protocol at the bottom, the base layer. Then TCP/IP kind of controls all of that on how it exchanges. That's the base layer. Then we have Filecoin on top of that. I'm sorry, FTP for files. Then we have HTTP for websites, SMTP for email, and then www. That kind of ties it all together. If I use that same framework, I can make a case that Bitcoin is like TCP/IP. It's the base layer. Filecoin is like FTP. Ethereum is like the www. And then we duke it out for the HTTP and the SMTP. Is that Polkadot or Cosmos or Solana or Avalanche? Don't really know. Somebody's like, no. It's one chain to rule all chains, Bitcoin. So it's Bitcoin, Lightning, L3, L4 that haven't even been invented yet. That's more like how money functions. So for money, I can see that, right? Gold is the base layer, then Fedwire, then ACH, then Visa, MasterCard, L0 to L3. Okay, I could see Bitcoin, Lightning, L3, L4, and something replaces MasterCard and Visa for the money network. But for the total computing network, I don't know. I kind of like Bitcoin at the base, Ethereum as the www. And then some other L1s that have a role.
Interesting.
But I could be wrong.
Okay. Well, I like that, the diversity of it. Obviously we're big into L1s here because we track Solana and Avalanche and Cardano and, many others that have done some interesting things around this. I want to get into, I want to kind of finish this up here with a question actually in from our audience, because I thought this was a good one coming in from Jen Smith. And the point is really a good analysis around what's been happening with Coinbase. If you look at the chart, this is just over the past couple of weeks. We've had almost a 76% run here on the Coinbase stock, trading now at 89, almost $90, getting ready. It looks like it's wicking over 90. And it's showing up pretty solid here. And a lot of people would look at this and say, all right, maybe is this the first indicator here, the positive things that Coinbase is holding their own against the SEC. The ETF might actually happen. We could see a lot more activity from BlackRock and Coinbase. Or are we in that real move on the next bull run? Back to your whole, seasons of where this market is going.
I think the answer is yes, right? Yeah. And it's a little bit of both. And why do I say that? Coinbase it's the necessary bridge from TradFi to DeFi. Yep. Mm-hmm. Ultimately, we probably don't need the recreation of banks and brokerage and insurance companies in the digital age. We could probably leapfrog that. And it's kind of like how the emerging markets leapfrogged from copper wires to mobile, right? New York City you'll get crappy cell phone service because the networks are weird. You go to, Lisbon, it's beautiful. Network is perfect because they just leapt over, or Malaysia, it's even better, or
Right.
Korea. And so, because they didn't have to deal with the old legacy infrastructure. So there are people that say, oh, Coinbase doesn't need to exist because we should get all of our coins off exchanges, only self-storage, only self-custody, sovereign individual. Okay, here's my problem with that. If the goal of all of this innovation and technology is to store value on a stick and bury it in the backyard, we got that. That's called gold. We've been doing that for 5,000 years. If the goal is to recreate the monetary base layer, which every central bank in the world owns, then they create money on top of that, currency, not money, currency, sorry. They create currency on top of that we all use to exchange for goods and services through debt and leverage. And there's a whole bunch of people say, fractional reserve banking is evil.
Right.
Really? Really? Name a country with a bad or non-existent fractional reserve banking system that you would live in. I'll wait, because you can't do it. No way.
Yeah.
Right? You need fractional reserve banking for progress. And whether it's old-fashioned fractional reserve controlled by the same Medici, Rothschild, JP Morgan network that's been in control for 800 years, or whether it's a new Coinbase, Kraken, Binance, whatever, centered world, I'm okay with that being an interim step. And I think Coinbase was unfairly valued because people thought that the SEC was going to put them out of business.
Yeah.
I think what we're seeing now is a relief rally saying, okay, they probably have a pretty good case against the SEC. And it turns out when BlackRock gets approved, they're going to use Coinbase as their custodian. That probably has information content, right? Yeah. So but I do think it's also a leading indicator a little bit to Jen's question that if you're looking for indicators of a change in trend, public markets always lead. Right?
Yeah.
They always go down before the recession. They recover before the recovery because the participants are more well-informed. Let's just say that the people that control the markets, they get better information. Not illegal, but just better.
Better information.
Better information. And partly it's because that's what they do for a living, but also they just get better information. So there is information content in the big move in Coinbase. But there's also information content in the fact that, Bitcoin itself is up 100+% this year. There's information content in the strength in Ethereum and what's going on there. Particularly if you think about Ethereum holding up in light of the merge and all the uncertainty around that. Sure. So I think it's a very insightful question. And I'm not trying to not answer it by saying a little bit of both, but I think it's a little bit of catch up because it was unfairly punished, but also a little bit of a leading indicator that, the halving is going to be a good thing.
The market is coming. Okay, so Mark, we're going to jump to our poll real quick. I want to kind of get an idea of what the audience was there, and we'll wrap this. Here we go. Okay, did the face melter rally begin for crypto? Yes, but it'll end soon. Yes, just getting started. No, we are going to begin later. So almost 51% still think we're a little bit further down the road.
I like that. What I like about that is the true face melters tend to happen post-halving. Yeah. So the year leading up to the halving, 100% move is 100% move. We like 100% move.
It's a great day. It's a great day, right?
But that's not really the thing that you just look back and say, wow.
Change, life maker.
We went from 10 to 60 in, 4 years ago. That was a face melter. And that was post-halving.
Yeah, for sure. Mark, always great having you on the show today. We appreciate you guys stopping in. Thanks so much.
No, thanks for having me, and we'll see you again soon.
All right. Excellent. All right, so you guys are tuned in maybe over on the podcast side of things. Make sure and jump over here to the YouTube channel. You catch these live streams just like this. And of course, the way you can do it is subscribe to the channel, hit that little bell, and make sure and smash the like button, because it is one of the things that helps others find these videos and also begin their journey around crypto and understanding blockchain and really where the next financial evolution is going to go. All of that happens because of you guys. So just hit that little like button. You're in like Flint, and that will be great. Of course, if you guys want to reach me, you can do it out there on Twitter, @Paul Barron. We'll catch you next time right here on TechPath.